Welcome, folks. This is Tom O'Brien of TFNN. We go 5 days a week. We go 10 hours a day. We go 24 hours a day on the internet at TFNN.com. Always remember, folks, whatever you think about, you bring about. Whatever you focus on grows. Hope everyone's having a great day, safe day, and stay warm out there, folks, because the chill is across the air. This is a quote from an unknown writer. Dare to believe. That's a beautiful thing. Market-wise, let's take a look at it out here. The Dow Industrials finished down 44. NASDAQ was up 18. S&Ps were flat. Gold contract up $7, trading at $1,207 an ounce. Now, gold's going to need more juice, folks. You had the gold contract yesterday reject lower price. We had lighter volume. What we had out here today is this, is that the gold contract ran up to a price point of $12.22 or $12.06, but it ran into that level with lighter volume. So you have two different things happening here. We're coming into a Friday, and we've had really a down, 3 days in gold. That is saying that, what, 12.03 is probably going to get tested. We'll see whether volume comes in or not. Silver market, what do we have with silver? Same kind of setup in silver. What we have with silver, silver also rejected lower price yesterday. Now, this is where it gets cool, though. The difference with silver, and this is what we did need, is that silver had volume come in as that little baby was trying to push topside. Not a huge amount of volume, but it had a little bit better volume characteristic. Still set up, though, that silver, we're at the 1641. More than likely, we're going to see that 1630 level tested. Bonds, the bond market. This is the. Oh, here, let's do oil first. We take a look at oil. What we have with oil out here is this. Oil today pulled back 94 cents. Inside that oil market, what you have is that we pull back on 86,000 contracts. That looks to me like we're really going to have some movement up until the $50, $58 mark. And right now we're at 51. So let's talk about oil for a second, because I'm going to put this on a continuous contract so you can see the correlation. And the correlation is pretty intense. And what it is this, folks. When we take oil and you put this on a continuous contract, what you're going to see, let's see, put this up here for you, CL1. So we take this, you put it on a continuous contract. What you're going to see is that oil came into the lows of 2008. We hit a price of 43.58. The low is 32. What oil has to do with a vengeance is get up and into oil's a dead cat bounce till it gets like 77. Yeah. So oil can do a heck of a bounce and still be a dead cat bounce. It's pretty intense. And I expect the way this is looking right now, this is where this is going to, man, this is so much stuff happening right now. Because if oil's wants to bounce, so watch the divergence that you're dealing with out here. If oil wants to bounce, that would make sense that the dollar wants to go down. If the dollar wants to go down, that would make sense that bonds want to go up, because that means that the dollar's been going down, that rates wouldn't want to go up. That's one scenario. I can see that scenario. But now watch this scenario. The scenario, if we pull up the bond market, let me pull the bond market up right now. And this is a very large change of my own thinking about where bonds are going right now. I've been bullish bonds for a long period of time. And what we have with bonds is this. We came down off the high. First off, we made a high. The high wasn't bad in the 10-year. The high, we did 1.7 million contracts. That's a big number, folks. That's a good number. So it's not out of the question or out of my even head that we can go back to the highs just yet. But watch what we're doing right now. So we came off that high of 107. I mean 137. 130.7. Yeah, 131.05. the last 2 days out here, not today, yesterday we had done 1.6 million contracts, the day before 1.6 million. Today we did 1.1, and that's the problem. Here's the problem. The 1.1 today, we got to a price point of 128.08, meaning you're going up, even though it closed down. It was trying to get above the highs of yesterday and couldn't do it. So now what you have is this. You come down with volume, you're going up, and it's trying to get into a higher high, and no one's buying. That looks like you get a small ABC structure on the way down. 131 is your A point, and 127 is your B. That's 131.04. So what you have, 131.05, yeah. So you have 4 points. If your C point is out here today, that brings you to a 124. Now, a 124 is going to be crucial. Why? Because your swing point of December 24th is 125.30. If we come down with volume, then it's going to be a big heads up. It's going to be that's going to be the different dynamic that we have happening inside the bond market. That would be saying that whether the Fed goes up or not, the market itself is raising the rates, and the way it's raising the rates is that it's selling more bonds than it's buying bonds. That's the technical setup. The fundamental setup inside the bond market is a lot harder to basically get your head wrapped around. The reason being is that we're at 2.1 on a 10-year. That is still a huge rate in the context of where rates are across the world. France is at 0.7, Germany's at 0.3, Spain and Italy are broke at 1.5. Bottom line, we'll see where this shakes out. Bottom line, if you want to refinance your house, if you're looking for a house, go get it. Don't even think about it. Just get it. King dollar. Let's take a look at King dollar. This is what we have happening with King dollar. King dollar out here closed out the day at 94.50. King dollar is what's going to release the most amount of information for us. And this is whether it's going to be bullish or bearish. And the cool thing is that it's either going to hit a high or hit a low. I mean, that's what it comes down to. And right now, it has been in the middle of that range for a full month. The high that we're talking about was the high that was generated on the 26th of January. That high is 95.85. The low we're talking about is the low that was generated on February 3rd. That low is 93.38. Now, thus far, the probability would be that we are going to go after the low first, and this is why. Let's see, we take a look at this, and what you're going to see is that that low that was generated out here after the high is a high volume low. So if we get into the low, let's say we get into the high first. Let's say we get into the high first. Today we did 31,000 contracts. The high that was generated out there on the 26th, we had 35,000 contracts. We get into that high, we test that high with lighter volume, your probability goes even higher that the February 3rd low, we're not only getting into it, we're going to get into it with monster volume, and basically that would be saying that the dollar index, in the dollar in general, has volume off the high, and you're going to have a very large correction. That's the bearish part. Bullish part would go like this. You come into the low of February 3rd, you have lighter volume, you reject that lower price. What that would do, that would say, guess what? Dollar wants higher price. You're at 94 right now. That you'll see if you do put this on a continuous contract, what you do have on the dollar, the next higher swing point on this dollar, if we bring this back, is pretty substantial. The next swing point up here is 99.40. That would be a monster move, folks. I mean, that would just be a monster move. So there's a lot of moving pieces right now that will give us a huge amount of information. The dollar being the largest one. The reason the dollar would be the largest one, if we go after the February 3rd swing low and you have higher volume, guess what? That would be saying commodities are going higher, dollars going lower, bonds are also going higher, lower yield. You do just the opposite. You break that February 3rd swing low with light volume. Guess what? That'd be saying you're going to go higher in the dollar, lower in bonds, lower in commodities. You stay right there, folks. I'm Mr. Basil Chapman coming right up. Today